Hello, this is Mike Turner. This is another session in our Getting the Most Out of the TurnerTrends Tools series that I'm taking you through, and today's session is about the stop loss. So let me kind of take you through what my thinking is on the stop loss and the theory behind what we're doing and why it is so very important to the process of knowing when to get out of a position. Here I've pulled up Apple, and we can look at it. And you can see that it doesn't really matter what time of it is as far as the where we are in this right now. In this case, it's in a very solid move higher. A lot of good things about it. So let's just say that you had bought Apple right here at the point where it gave its first indication of a good strong buy signal. This blue dotted line is the 200-day moving average, and so when a stock moves above the 200-day moving average by enough, and we have a percentage for that based upon the stock and a lot of other elements, the volatility and the like. When it moves high enough above, it gives a buy signal. In this case, it gave a buy signal and almost came all the way back down and hit the 200-day, which would have been a stop out in that case. And I'll explain that to you here in a moment. And before it reversed and went higher, and it's been going higher pretty steadily since that period of time. And I'm not trying to say that you should buy Apple or not buy Apple. This is just an example of what I'm talking about. And you'll see over here that the stop loss is 129.89, and that would put it right about in that area right there where I've got the cursor. Now, the way this is calculated, and the purpose of the stop loss is to give you a point where you can know that it's a good idea to exit the trade if the trend has reversed. For example, here the Apple went up nicely higher, it rolled over, it moved down low enough, actually gave a stop out right about there, and so when that trend reverses, then the whole thinking about being in a position is that you want to be, if you're going to be long, you want to be in the position as long as it's trending higher and get out of it when it's trending lower. You're not trying to guess where the top or the bottom is, but when the trend changes. And in this particular case right here, it changed, gave a stop out right about there, and then moved into a neutral condition, and it stayed in a bearish condition until this point right here, and it gave another buy signal. So how do you know the difference between when a stock moves down like it does here, which is a fairly significant move lower, and a change in trend, which is here? So what you want to do is make money from this point to this point. You want to get that big difference between here and here, and you want to get out when that stock is moving lower, and then you want to get back in when it cycles and moves back up again. But you don't want to buy here, it move all the way over to here, then go all the way back down, and then maybe the market continues to move lower, and it would be going lower, and you never know when that's going to occur. So the key here is to know when to get out when the trend has changed, and the way we do that is based on volatility. So when the volatility stock, and that's what we call the expected move, that's this right here, $9.02 right now, for example, with Apple. I know that if Apple moves down in the upcoming 5 trading days by more than $9.02, it is likely moved from an uptrend to a downtrend. And if it's moved from an uptrend to a downtrend, then I probably want to exit the trade, unless there are other reasons that would keep me in the trade, which would be unique to each individual and the stocks that they own. So what we do is we calculate when a stock, what that price would be if we basically take this expected move and subtract it from the previous week's lowest low to give a little more cushion, and we say the stop loss is 129.89, and it moves up as the stock's price moves up, and when the stock's price begins to move down, it does not move down, it stays up. So it's right now at about almost $130, which is right about there, which means if Apple moves down to that point, then from a volatility perspective, it has moved from an uptrend to a downtrend, and we want to get out. We want to pick it back up when that trend moves back to a bullish trend. We want to be in the long runs between here and here between here and here, and we want to be out of the stock when it's weak and moving lower. So that's the purpose of a stop loss, a very important number to stay up with and to monitor. So anyway, I hope that has been helpful to understand how that works. And if you send me a question if you've got one at askmike@turnertrends.com. You can always call us at 844-818-9444. So again, thank you very much. Hope you have a great day. Bye-bye.